Hello, welcome to Session 3 Foreign Exchange Market. In these sessions, you are going to learn about the foreign exchange market. So, the session and module goal is students are able to understand the mechanism of the foreign exchange market. This is the learning outcomes. First, to identify the structure of the foreign exchange market. Second, to identify the components of foreign exchange transactions. Third, to study concepts related to spot markets. And fourth, study the concepts related to the forward market. Okay, let's have a look at the foreign exchange market. So what is foreign exchange market? So foreign exchange market encompasses the conversion of purchasing power from one currency into another. There are 5 participants in the foreign exchange market, which divided or categorized into 2-tier market, interbank and client market. Those 5 participants are international banks, bank customers, non-bank dealers, foreign exchange brokers, and central banks. And there are 3 motives for international transactions. The first is arbitrage, the second is hedge, the third is speculations. In the foreign exchange market, there are 2 markets. The first is spot market, the second is forward markets. Let's have a look at the spot market first. Spot market involves almost immediate purchase or sale of foreign exchange, and it takes 2 days to settle. And in the spot market, we have spot rate quotation, which can be stated in direct or indirect quotations. And one can have 2 positions. The first is long positions and the second is short positions. Long means buy, short means sell. And we have spot rate quotations. A direct quotation is simply a currency pair in which the domestic currency is the quoted currency, while an indirect quote is a currency pair where the domestic currency is the base currency. So this is an example of spot rate quotations. We have direct quotations and indirect quotations. The first column is about the currency, the second is direct quotations, and the third is indirect quotations from the US perspective. And still we have the example of spot rate quotations. So let's have a look at direct quotation for the pound is $1.5405 is equal to 1 pound. Meanwhile, an indirect quotation for the pound is 0.6491 pound per $1. Note that the direct quotation is the reciprocal of the indirect quotations. So, for the quotations, we have 2, the bid and offer rates. Bid is the buying rate and ask or the offer rate is the selling rate from the perspective of the quoting dealer. So the interbank foreign exchange traders buy currency at the bid price and sell at the offer or the ask price. And the difference between ask and bid rates is called spread. And the spread is measured in pips. So what is point and a pip? A point is 1/100 of a cent or penny, and a pip is 1/10 of a point. So if we have the exchange rate is 1.2545 and 1.2585, so this can be expressed as 4585. And 1.25 in the beginning or in the first, for the first number, we call it the big number. And a pip is the smallest price increment in foreign exchange trading. So basically it's 4 decimal point, 0.0001. And only for Japanese is the second decimal point, 0.01. And the most liquid currencies trade at less than 10 pips. So this is the bid-ask spread. The bid is the price a dealer or the bank is willing to pay for you for something. The ask price is the amount a dealer or a bank wants you to pay for something. So this is the formula. Ask minus bid divided by S, you call it percent spread. So this is an example. And the next one, we have cross exchange rate. So cross exchange rate is an exchange rate between a currency pair where neither currency is the US dollar. So if we have A, B, and C are three currencies, then A over B is equal to A over C divided by B over C. So this is an example. Let's say we have $1.5 per 1 euro and we have $2 per pound. So what is the cross rate for euro per pound? So this is what you can do. You can divide $2 per pound with $1.5 per euro. So this is the cross rate, 1.3333 euro per 1 pound. So this is still an example of the cross rate. Now we have triangular arbitrage. So for the triangular arbitrage, it involves a cross rate. So in here we have three banks, Deutsche Bank, Credit Linus, Credit Agricole. So if we calculate the no arbitrage, so you can divide the Deutsche Bank bid price with Credit Linus ask price. So this is the cross rate for no arbitrage bid price, 1.1763. And you can calculate the ask price for no arbitrage by dividing 1.5405 ask price of Deutsche Bank with $1.3087 per euro for bid price of Credit Linus, and you can have 1.1771. So if we have a triangular arbitrage and we calculate no arbitrage positions, and you can see that the ask price of Credit Agricole, right, is 1.1760, and the one that you calculate is 1.1771. So you can start with 1 million pound by selling pound to Deutsche Bank for $1.540000, and then you can buy euro from Credit Linus and you receive 1.337132, and in the end you can buy pound from Credit Agricole and you receive 1.000247. So did you gain any profit? Yes, you gain 247 pound as a profit. And the last one, we have forward market, which involves contracting today for the future purchase or sale of foreign exchange. So basically, no money changes hands upon entering the contract today, and it quotes for maturities of 1, 3, 6, 9, and 12 months. And it has a forward quotation. So this is the end of the sessions, and we have two questions that you have to answer. The first, A, blah blah blah, is an agreement between buyer and seller that a fixed amount of one currency will be delivered at a specified rate for some other currency. A, euro-dollar transactions. B, import or export exchange. C, foreign exchange transactions. D, interbank market transactions. Question 2. D, blank is the mechanism by which participants transfer purchasing power between countries, obtain or provide credit for international trade transactions, and minimize exposure to the risk of exchange rate changes. A, futures market. B, Federal Open Market. C, foreign exchange market. D, LIBOR. Thank you.